Okay, hi all, this is Akshara Menon, analyst at PMS Bazaar. Welcoming you all for the exclusive Friday webinar on the topic risk and reward and how to perform from the market movements and harness from market volatility, market volatility. Of course, this topic is much in need of today. In current market scenario, it is more important to achieve a good balanced approach for capitalization the market movements, as Nifty has come to the end of its steam. For further elaborate, we have two efficient speakers from Dolat Capital. Moving on to the first speaker of the day, Mr. Abhishek Jaiswal. Mr. Abhishek Jaiswal serves as a fund manager at Dolat Absolute Return Fund, bringing him with more than 17 years of extensive experience in the realm of fund management and equity research. Being a chartered accountant, Abhishek is not only an expert but also a true specialist and investment authority, particularly in the field of fundamental research. His career journey includes successfully managing India-focused long-short funds, long-only portfolios, and sector portfolios. Abhishek has made a lasting impact on financial industry through his collaborations with renowned investment teams across hedge funds, portfolio management services, alternative investment funds, and mutual funds. Notably, he has contributed his expertise to organizations such as Nippon Life Asset Management Company and Marshal funds. Moving on to the next person of the day, Mr. Aalap Shah. Mr. Aalap Shah brings over 17 years of invaluable experience in the Indian capital markets onto the table. He's a specialist in trade of realm of fundamental strategies, skillfully upbringing of domains of quantitative analysis and fundamental insights. Mr. Aalap's professional journey has encompassed both sides of the industry, serving on a sell side and a buy side. During his tenure as a quant analyst on the sell side, he accumulated a wealth of knowledge and practical acumen, amassing more than 8 years of experience in esteemed institutions such as Phillip Capital, Standard Chartered Securities, and many others. Transitioning to buy side, Mr. Aalap dedicated over 9 years of his career in managing funds for distinguished organizations like HDFC Life and Birla Sun Life. Presently, Mr. Aalap is the fund manager at Dolat Absolute Return Fund. And of course, for all the participants out there, if you want to put any questions, I would request you to put it in the Q&A box and not in the chat box. Now over to you, Mr. Abhishek.
Thanks, Akshara, for a well introduction. So, are we starting with the poll now? So let's have a poll before we start.
Yeah, so let's open the poll for the audience. I request the audience to mark their answers. And obviously they'll have an option of yes and no on their slides on the screen, I must say. So the question is volatility not risk? So if you feel is it a risk, then you must say yes. And if you feel it is not, then no. Shall we end the poll now?
Yeah, end the poll. So it's almost normally 80. Great. So it's a tie, 46 and 54 with 83% participants talking about it. Sure. Great. So good evening, everyone. To all the participants here, thank you for taking your time out on a Friday evening. Today, a topic at hand is, I'll just share the PPT first. Okay. So today's topic of discussion is risk and reward, how to profit from market movements and harness market volatility. So we just had a poll and it's almost a tie with good 80% of the participants participating. So we are going to have an exciting session of discussing, the market movements and market volatility. So let us begin. So our scope of discussion today is going to be around, the first part is going to be around the macro part, which is going to cover the global landscape and how India benefits from it. The second part, what we are going to cover is the volatility part and what are the investment strategies that we can adopt to enhance our portfolio for our clients, for ourselves. So that's the discussion going to be there around. So the first part, the global landscape, the changing face of nations. So this is a term coined by Ray Dalio. He's written a book on this, the same subject. I recommend everyone from the audience to do read it. It's a very interesting book where, it talks about the rise and falls of nations. So now I need your, to take you down the history line. So basically, let's go to 1945. So that's where, the power changed from this part of the Atlantic to the other part of Atlantic. And that's where the whole story started. The US came into the forefront. Now, the interesting part I would like to share with you is that at that point of time, America had a higher GDP than Britain. But the real power shift happened and dollar became a reserve currency after the Second World War. And what was led to that was strong leadership, inventiveness, education. These are all the parameters of the left-hand side. So that's how the rise of nations happen. And then what happens is you have the shifting of generations that happen. So that's where, the less productivity and economies of scale start coming down. And now in the third phase, they are there. So in terms of, large debts, printing money, and it has to end some point of time. And this has been seen across times. How Britain came into the forefront of global power, then United States of America. Okay, then we look at our continent, where we say, the Asian miracle happened. The World Bank coined the term Asian miracle. So in Japan in 1964, Korea in 1967, China 1994, and India in 2018. That's what we believe is the start of that journey. So what contributes to that? So let us examine that. So before starting this, I'll just say about a quote from Ray Dalio. Human productivity is the most important phase in causing world's total wealth, power, and living standards to rise over time. So I want everybody's attention on the left-hand side of the chart. So you're seeing the Japan, start of the demographic dividend that started playing. So from 1964 to 2004, that's a good 40 years the phase was there. There's similarly South Korea. Again, a 40-year phase is going to about to end in 2027. Then we come down to India. So India, we are starting that phase now, 2018. And this is supposed to last till 2055. Now, what this is triggering that? So now, by 2030, we are going to have a working population of more than 100 crores. If you look at India's addition to the global force, is going to be almost 20%. So that's going to be there. Then, and that is going to be there for next 3 decades. So if you look at the bottom right of the chart, India's share, it's going from 64.2, it's going to be there till 61. So percentage of working age population is going to be constant throughout. And what happens when you have a high working age population? We saw in that Asian miracle, you consume more, you demand more, and there is a GDP growth that's going to happen. So China is, if you look at China is going to see a decline from 64% to almost 50% is going to come down. So working age population. So there a different set of problems are going to be there. So that's where this demographic dividend is our time in India to take this opportunity. So if you look at India's GDP growth, we were almost 9th in 2010. And in 2022, we were the fifth largest economy. So almost doubled in 10 years. And we are going to, again, by 2028, we are going to be the 3rd largest economy. And what's going to be the impact of this? The second, the per capita GDP. If you look at the per capita GDP, it's going to rise from $2,500 odd to $4,000. So what does this mean? It took us almost 20 years to come from $460 per capita GDP to $2,000. And now doubling is taking us just 10 years. So we're going to get the power of compounding. And you see, India has a very big base. The poverty was very high. So as and when people come out of poverty, the lower middle income class become the higher middle class. They are going to consume more. Just to throw you some numbers, in 2030, we are going to be consuming around $3 trillion, almost 100x of a GDP, 1x of a GDP. That is going to be the consumption trend that is going to be there. And that's where the opportunity lies for us. As investors, we might get, premiumization happening. That is going to be covered in the next part of our topic, but that is where the things are getting exciting for us. So another question arises. How will we reach the 5 trillion GDP mark? So these are the 4 pillars of growth that we see that's going to be there. The first is the defense. Now in defense, what we have seen is in 2022, we exported almost $2 billion of goods. And that is going to double in next 3 years. So we're talking about $4 billion in next 3 years. This is the first time we are, pushing or exporting defensive goods. And that too at a very competitive cost. What's advantage that India has is competitive cost. The second thing is the infrastructure. Both the physical infrastructure and the digital infrastructure. Both is going through a massive change. So we have doubled the airports from 2014 to 2023. We are doing 10,000 kilometers of roads a year. New roads are being added. That's what we are doing in terms of infrastructure. So it was said, America was built on roads. And similarly, we are seeing that phase now. Even when we started, 2007, or even Bombay International Airport was not that good. But then you're seeing that change coming in. The second part of the piece is the manufacturing piece. India always, in the first part of the early 2000s, we were always a services oriented. Manufacturing was always a challenge because there was power shortages. There were not enough, policies of incentive from the government. That is changing now. So, we are going to see Apple iPhone is already being manufactured in India. Then semiconductor chips, they are going to be manufactured in India, which we never thought of. So, and you can see a country, I went to Taiwan, so see a country like Taiwan, their whole economy is dependent on semiconductor chips manufacturing. So we are going to do that. So that's the change that is happening. The third is the services part. The IT has always been a backbone of our exports growth. And that's going to be continue to do so because there are opportunities in artificial intelligence and other areas. The fourth part, the pharma piece. So today, US FDA inspector gave interviews and he said, pharma, India is going to be a major part of US exports. And it's going to increase because the FDA related issues that were there, that's coming down. So no, inspections issues that were, that hampered in the 2014 to 2018, that's going to be there. The fourth is the consumption and premiumization that's going to be there. With the per capita GDP increasing from $2,500 to $4,000, what's going to happen is you're going to see a premiumization trend. And that you can see in the cars that are being sold. So earlier Alto used to be the number one selling car in the country. Now it's WagonR. And so last month data shows Swift is the highest selling car in the country, very close, followed by Baleno. So, you're going to see that premiumization coming in. So maybe next 10 years down the line, we'll have a top-notch SUV, which is going to be the best-selling car in India, which we never thought before that's going to happen. So these are the pillars of growth. So just the charts. So I want your attention to put on the blue line. So blue line is the absolute number. And the red line is as a percentage of GDP. So we are seeing that constant increase in the expenditure that is going on, and it's in the upper trajectory. Similarly, for manufacturing, IT exports, and the premiumization trend, we are seeing a constant steady line. So it's in an upward trajectory. And that is going to get us to the $5 billion GDP. Now, taking an analogy, path to growth is not always easy. And it's an uphill path that everybody understand. But you need four things to go uphill. You need a good driver. And today, the stable leadership that is there in India, that is aiding that. The second thing is the policies, the engine of it. So the policies, maybe the implementation of GST, Make in India, Atmanirbhar Bharat, Gati Shakti. So these, all the policies are helping to India becoming a manufacturing hub, which it was not 20 years back. Then the third is the fuel. If you look at today, the private capex and the private balance sheets are not that leveraged. Your banking system, the NPAs are at all-time lows. So that's going to happen. That's going to fuel your economy and your credit growth. And the wheels, the demographic dividend that is going to be paid. With a median age of 28, we can expect a very large population to participate in this growth. And that's going to fuel your GDP growth. So all path is not that easy. We are going to see some challenges and headwinds to this path. So what are the challenges? The first is the global slowdown. So what's happening is the rates, the inflation is not coming down on the Western world. And there are the reasons for it. So basically, the growth globally could be an issue, and that could impact your exports growth. The second thing, which is going to be for next 2 decades or 3 decades, is the geopolitical issues. The Russia-NATO war that is there, it started from Russia-Ukraine war, that's become a NATO war. And you're going to see increasingly geopolitical issues popping up in different parts of the world. So that disturbs the pattern. Then there is the third challenge is shifts in global patterns. Now, if you look at that, the climate changes that is happening. So you had the hottest summer in Europe after almost a century. So what that's going to do is the rain pattern and climate changes was going to affect the consumption patterns globally. And the fourth is the competition. So we have competition from Asian countries and they're always there. So that could take a major share of what China plus one policy or China shift that is going to happen. So these four challenges are there. And then the self-goals that we have to avoid. The first is to keep your inflation and deficit in control. I mean, stability of food prices is a challenge that has to be seen because we have the largest population in the world and we have to feed them. Then the leadership and policy paralysis. So elections stated in 2024 and state elections lined up, and sadly the trend is it's populist is happening. So that could hamper our growth. The third is the rural demand. With the climate shift happening, you're seeing erratic patterns of rains. That could impact the rural demand, and that's going to be a major challenge. And the demographic issues. So the challenge for us is that we are going to have a large working population, but whether they are going to be skilled enough or whether they are going to be ready to take up the skilled jobs. And in fact, the policies are in place to make them enough skilled, ably skilled in that sense. That's going to be a major challenge for us. So we got to watch out for these reasons. So what happens in the future? So I'll finish my macro part and then I go to hand it over to Aalap. So we're going to discuss about volatility. So Aalap, over to you.
Thank you. Thank you, Abhishek. Always interesting listening to your macro piece. Thank you, Akshara, for this and PMS Bazaar for the opportunity. Again, a large thank you to the participants. Spending a while on a Friday evening is always difficult. So again, thank you. So quickly, we start with the volatility and the directional part of the whole piece. So we started with the poll. The poll asked that is volatility is it a risk or not a risk? So we just build on that process that whether you look at volatility as a risk or you should look at volatility as not a risk, right? So let's see how this functions. So let's understand the base part or where volatility comes from, right? There is always slight bit of volatility in the system, but when does it become very difficult to manage? Secondly, how do you differentiate it from risk? So first, let's address that question. So inflation is the core issue out here. Inflation is a byproduct of growth. So while Abhishek was talking about growth, I'll be the devil's advocate. I'll be talking about the byproduct of growth, that is inflation. So when inflation sets in, you've got certain problems which crop up. First, your growth and your money supply. This starts retarding. That starts reducing. Second, your interest rate starts inching up. Now, this whole structure, whole shift changes the balance sheets of people, changes the balance sheets of corporates. So how does this change? The personal spending generally comes down. The government spending generally comes down. So the top lines of corporates, they start getting a hit. The midline of corporates, they get hit because interest rates are moving higher. So the working capital requirement inches up. The interest on the debt moves up. So the midline gets hit and automatically the bottom line also takes a hit. So with that, the P&Ls and the balance sheet becomes slightly difficult to understand. That creates a haziness. Now that haziness is what brings about risk in the assets. And that risk brings about volatility in the stock prices. So the financial assets, the prices of financial assets become more volatile. So risk is a separate part, volatility is a separate part. Risk comes from what is happening in the macro environment, and the fallout of that, what we see in the price, is the volatility. So this is how we view the whole process. And that's how we try to incorporate that in our portfolios. I'll just take a quick case study. This is something that happened between 2010 and 2014. This is a news clipping, Economic Times. This was on March 19th, 2010, when we had the first rate hike after the inflation inching higher post the GFC. At that time, our real GDP growth was close to 12%, inflation was close to 10%, and our interest rates were close to 4.5% sort of a range. So with the first 25 basis points uptick in 2010. And then comes 2011, the next one, next slide. This is 2011 newspaper clipping. This is September 2011, wherein we see that there were 12 rate hikes by then. And the interest rates had moved up to 8.25%. So from 4.5%, we had moved to, or 4.75%, we had moved to 8.25%. So let's look at the economic scenario in those 4 years. Your inflation goes down from 10% to 4%, which is what we wanted as a nation. but goes down the GDP growth also from 12% to 6%. We halved our GDP growth. What happened to interest rate? It moved up from 4.5% to almost 8.5%. We doubled that up, right? So in that situation, what happens to the market? We look at Nifty. Nifty was flat. It was largely in the range of 5,000 to 6,000. We had dips in between, but it was largely in the range of 5,000 to 6,000. Mid-cap index took a beating of close to 25%. Small-cap index took a beating of almost 40%, right? So what does that mean? Are we always going to have a problem? No, that's not the thing. So there's an interesting book written by Thomas Montier, I believe. The name of the book is the Little Book of Behavioral Investing. So there he says that there are two formats to our thought process. One is the X format, and the other is the C format. X deals with emotions and C deals with logical thinking. Our instant response is generally emotional in nature, and that is the reason why on a shorter horizon, we will always see such sort of scenarios building up, wherein the market is led more by leverage, liquidity, sentiments, news flows. But on a longer horizon, that gets creased out. So here, if we see, on a one-day horizon, if we see Nifty, what is the possibility that you make money on Nifty? It's 46%. Right? So 50% of the time you will lose money, 50% of the time you will make money if you bet on a single day. As you expand that horizon from 1 day to 1 year, that probability increases to 75%. If you go to 3 years, that increases to 93%. And on a 5-year horizon, there is a very little chance that you will lose money. Right? Or 70, very little chance that you will lose money. Why is that so? Because you're playing the whole economic cycle. Right? So here we have zoomed out. We have zoomed out and we are seeing on a longer horizon. Right? If I take different indices also out here, if I look at Nifty, if I look at Nifty Next 50, 200 mid-cap, it's the same thing. The data that I am showing out here is a 3-year rolling return on a compounded return. You see last 5 years, last 10 years, data since 2008 or data since 2004. If you see the returns largely stay in the zone of 11% to 13%, but the volatility keeps shifting. Right? So if you zoom out further, the volatility eases off. If you zoom in, it's going to be slightly more volatile. So from a 3 to 5 year, let's go one step further, zooming in to a 1 year sort of a horizon. Now, if you see over here, on any single year, a 10 to 20% intra-year decline in the index is totally a possibility. It has happened almost 40 times out of the last 43 calendar years. So a 10% intra-year dip is given. But is that the hit? No, not really. If you see out of that, 80% of the times we have recovered back. So 34 out of these 43 years, we have actually ended in green. We have ended in positive returns. So longer horizon, well managed. On a 1 year horizon also, it's decently managed. So then we went further. We tried to drill in further. And we started looking at it from an intra-month sort of a number. So just to look at what these numbers tell me. I've taken 3 data points over here. I've taken the open price at the start of the month, the low for the month, and the close for the month. We took data for last 27 years. We got close to 327 data points. And what we realized that out of that 205 times, actually from the open, we dipped down significantly. And then there was a recovery. So we have categorized those recoveries and the falls. If you see in the green portion, if you see in the green portion, a 2 to 4% sort of a fall, which has happened close to 66 times out of those 205 times. We have recovered well. We have recovered more than the fall. So actually, first 2 to 3% fall during any month is not a cause of concern for one and all, right? It's something which is very simple. But if the fall is more than 4%, the possibility of recovery starts diminishing. Even the extent of recovery starts diminishing. So that's where you start feeling the pinch, right? So that's where the issue steps in. That's where the problem steps in. So till first 2-3%, and that's where our hedging policy stands. We say that it's manageable, the volatility is manageable. If it's more than that, that's where we need to look at it more carefully. Now, we saw that in conjunction with the macro indicators also. So if I connect this yearly number with macro indicators, GDP growth, my inflation numbers, and then I see the same thing. What we realized that during the years when inflation was on the higher side, this cuts used to be slightly more deeper, right? So we used to go beyond 3%, beyond 4% in the downtick. Also, such months used to be more frequent, right? So a frequency of downtick increases, a frequency of a deep downtick also increases. So this is typically how you can, probably organize your thoughts as far as your overall inflation piece is concerned and or the overall volatility piece is concerned. That's how you can look at the volatility piece. So we looked at the returns part. we looked at how volatility plays out, but how do you harness benefit out of them? How to gain out of that? So let's understand that. So typically, what is volatility? Volatility is a measure of risk. It's a measure of dispersion. It tells us what sort of risk we are sitting on, right? So that is what it tells us. While we generally say that it's a price risk, it's actually not price risk, it's a returns risk. That is what it measures. So how do we harness that? There are two ways in which this volatility gets measured. One is the historical volatility, which has already happened, the past piece, right? It's already done, it's exposed, or you can say it's realized, it's actual, whatever. The other one, which is the important one, is the implied volatility. Implied volatility comes from your options part, right? So every option has a volatility priced into it. So if you look at the options pricing piece, all the pieces are given, all the subparts are given, the strike price or the expiration date, everything is given. It is only the volatility which the market decides. And if market decides the volatility, we have the capability to trade that. Right? That's where the opportunity to harness it comes. Now, how can you trade that? The trading of that is called options arbitrage. Now, just again to step back and just tell you about arbitrage, there are three formats of arbitrage, and we have placed it as per the risk categories and the return categories. First is your cash futures arbitrage, the normal arbitrage funds that we talk about. The other is the options arbitrage, how to harness volatility that I'd love to talk about. And finally is the statistical arbitrage, which is the long shot that people do. So I'll start with the cash futures arbitrage, and then from there I'll move to options arbitrage. So cash futures arbitrage, we buy a stock on the cash side, we short the futures, right? So what are we trying to make out of this? We are trying to make the interest rates from it. So basically cash futures arbitrage is not typically an equity product, it's an interest rate product, right? We are trying to take the time value from it. When you look at options arbitrage, you've got two benefiting points over there. First, you can take the time value out of that. You can also take the volatility benefit from that. So that's what we typically do when we talk about the options arbitrage. So basically, we are going to look at option strikes, multiple option strikes, and based on that, we are going to create our volatility, our arbitrage positions. So how does that help us? First, it completes our overall structure in terms of arbitrage. So we are doing cash futures arbitrage, we are doing options arbitrage. So we are using that across multiple instruments. Second, on events leads to spike in volatility, right? Because budget, elections, results, there is a concern around that, and volatility spikes. So typically at the time, what we do, we try to harness this volatility. So we are generally either long on the volatility piece or short on the volatility piece, but the direction, that is what we hedge. We don't have an exposure to direction. We have the exposure to the volatility piece. This can happen within strikes as well. And this whole process that we do is called the delta neutral trades that we do. The risk management part is extremely important over here because you can have sharp moves at any given point in time. So we have got very stringent risk management process to it. And typically these are all technology-driven methodologies. It's by the use of technology that we do these things and not through typically a manual sort of a thing. So we were all our technology piece also set into this. So typically if you look at things from your returns, moving into your volatility piece, how to hedge yourself, and then going into how to harness this. This is typically the tangent that one can utilize, right? How can a long short strategy help you in this process? I think Abhishek, you can help us with that if you can share your thoughts around that.
Sure. Thanks, Aalap, for a wonderful overview of volatility and how do you harness that. So now we are going to look at how long short strategy can enhance your value in your portfolio. So, before starting the presentation again, I'll just start with a quote. The way to maximize outcome is to focus on process. So performance is just the tip of the iceberg that you see. But actually, the performance is a function of what platform you are in. Whether you're a mutual fund, a life insurance company, or a hedge fund, AIF, PMS, then what kind of product you are offering, with what kind of risk profile. Then is the process. What kind of processes you have in place, the risk management process that is there. And the fourth is the people. So what kind of people, what kind of backgrounds they are running this strategy from. So that's where the real story starts. Now let me share with you a case study. So this is, so I want a participant's attention here because there's too much data that is there, but just we can focus on this. So there are style returns by calendar year. And if you look at, there are 8 types of strategies that is there. So value, nifty, dividend, size is mid-cap, low volatility, quality, momentum, and global. Now you see in equity markets, what happens is they go through cycles. So not every strategy will give you return at some point of time. You'll have strategies underperforming, you'll have strategies outperforming. But you got to keep on, believing that strategy, or you got to keep on allocating to that strategy. Diversification is the way to go. So if you look at, I want your attention to come to 2018, and just at the bottom of the pyramid, the value part, the value strategy. It's given, 2 years, 2018, 2019, almost 26% negative returns, and it was bottom of the pyramid, 14%. Why? Because interest rates were coming down, but then the strategy started outperforming. 2020, it was at the bottom, but then it's in 21, 22, because of the rise of interest rates, the strategy was performing at the best. So that's why no one strategy can give you outperformance. That's why the diversification is the way to go about it. Now let me talk to our part of the business, which is the 𝐀𝐿 AIF. I'm not taking the long only piece. I'm going to explain you the long short, what strategies are there in the market. The first part is the single strategy absolute return. So these are mostly market neutral strategy. Now, what do you mean by market neutral strategy? They will be not going more than a certain range of net exposure. So they would be plus 5%, minus 5% of the net exposure. And they mostly operate across asset classes, or they try to do it different. They play in different asset classes, but the strategy is only one. You're limited by your net exposure that you can keep. Now, the second part of strategy is the absolute return. Here, which we are present in this category. So here you can do two asset classes, single asset class, very different strategies that you can do. So here, a combination of arbitrage and a long short, equity long short strategy, or a debt plus a long short strategy, or a fixed income plus long short strategy. So in the multi-strategy absolute return funds, you have, using a combination to generate stable returns with minimum drawdowns. And the third strategy, which is globally a very popular one, long short fund benchmark. So here you're trying to do is outperform the benchmark over its cycle. And what you do in this strategy is you try to minimize your drawdowns. Now, how do you minimize your drawdowns? By reducing your participation in the downfall, by reducing your net exposures or going net short. So that is there. And how do you maximize your potential is you can go leverage. So SEBI allows you in 𝐀3 to go up to 2x. So increasing your leverage more than 100%. That's where you try to capture the upside of this strategy. So now let me, with the example, explain to you the long short piece. So long only. So here what we are doing is we are taking 5 parameters and we are comparing a long only strategy with a long short strategy. Okay. The first piece is hedging the shorting. So we are almost at all-time highs, 2-3% here and there. But now if the market falls, so what tools that are available to a long only manager versus a long short manager? So long only manager can take a cash call, or he can do his stock pickings, go towards defensive stocks. For a long short fund manager, he can reduce his gross net exposures. So if you're, giving him 100 rupees, he can get down his net exposure to 50. So reduce his participation, or he can go net short. That is the leeway that he has. So he can go below, he can be minus 20-30% short also in the market if the market falls on, and thereby helping you to reduce your fall. The second thing is the positioning part. So as Aalap alluded to, the longer the time you keep investing in the market, the probability of making money increases. So beyond 5 years, you have a very high probability of making money in the market, irrespective of what time you have entered. So long only fund managers have a very high time horizon. They're looking at from anywhere between 3 to 7 to 10 years. But for a long short, since you're expected to perform on the downside, so that's where your time horizon reduces. But there's a misnomer which I would like to correct. Long short funds, especially the benchmark ones, they don't give negative returns. They can give negative returns, but they'll try to not go down as much as the index falls, because they will be reducing their participation in the market or going net short. The third piece is the time horizon piece. So long only funds, typically investor is told to invest on 3 to 5 years or even beyond that. For a long short, it's typically 1 to 3 years. That's the time cycle we're looking at. Then the fourth piece is the sector agnostic. So what happens with long only, since you're benchmarked to an index and you're investing for a very long period of time, what's going to happen is you have to, be plus or minus on the benchmark rate. That's what you would be forced to do. Whether versus ours, the long short, here only restriction is 10% on a single stock. Rest all sector, you can actually keep changing between them as and when the views changes. And the last part is the strategies part. The strategy for a long only fund manager is restricted to an extent because he's just going to take long positions here. But for us, as strategies for a long short fund manager, we can deploy an array of strategies using options or using derivative positions to create that return profile for us. So with this, I come to the end of my presentation. Now, Aalap, can you just take us forward and just introduce our products, what we offer to our clients, and how we can help the participants, in terms of the return profile.
Great, perfect. So thanks again, Abhishek. So we'll quickly move to the products that we run currently. What is the idea behind those products? What is the concept, and what sort of returns we have been seeing? So typically, right now we have got two products in our bucket. First is the absolute return product. Just to map it to what Abhishek just mentioned, it's a multi-strategy absolute return product that we run. We use multiple strategies. I'll just come down to what it is. The other product which is in offering right now is a long short product, which is typically a benchmark product, and that's more like a hedge fund sort of a feel that one would give. So that's the two products that we run. The first one, absolute return, that's almost there for almost more than 2.5 years now that we have been running this. So the idea out here is basically to generate as far as possible non-negative consistent returns. So that's our first and foremost prerogative as far as this product is concerned. We are looking at a net long of close to 30% max case on the high side, but we can go net short as well. So the range is somewhere between -10 to 30%. There are two strategies that we apply over here: the market agnostic strategies, that's typically the arbitrage strategies that we mentioned, and the market related strategies, which are typically on the long short side that we utilize over here. It's a low to medium risk product. I think as a best case scenario, 1 year horizon would be a best time to get a feel of this product, because we put it right next to probably a debt fund or an arbitrage fund. So 1 year is the best case horizon. Our risk parameters are placed accordingly, so that's where the best experience comes by. And liquidity would be otherwise monthly, so entry exit would be slightly easier out here. If you look at the portfolio construction over here, broadly, I'll just talk about the product a bit. There are two areas in that. There's a market agnostic part to it, which is your cash futures arbitrage and the options arbitrage, the arbitrage piece that we just discussed, the harnessing of volatility that we just discussed. So that's exactly what we do in this product. A part of this fund does that. The second are the market related strategies, which is typically a long short and certain index related strategies that we do. So that's the two pieces. Those two pieces put together, we run this product. The second product, the long short product, that is an offering. We've got the SEBI license for it. We are just waiting for the rest of the approval. So soon we will be open for subscription over there as well. So that's the second fund that we are looking forward to. That's typically wealth product that we are looking at. From an income sort of a product, we are moving to a wealth sort of a product. We will be benchmarked to Nifty 200. Instruments that we'll be using is typically equity and equity derivatives. In both the funds, we use equity derivatives. We don't understand, honestly, any other asset class other than that. Our focus has always been equity and equity derivatives, and that's what we'll be looking forward to. The range over here is around -30 to +30%, so we can go significantly short over here, and we can even leverage. So that's something that is a very different thing that we are trying to do. The portfolio allocation will be divided into three pieces: the core portfolio, there'll be a participating portfolio, what we call as the hedging part, and the technical portfolio. So there'll be three pieces to the portfolio. It's going to be a high risk product, comparatively mid to high risk product. That's where I'll put it, because of the fact that we'll be leveraging it to 130%, or we can even go short over there. Minimum holding period, we'll look at almost 2 to 3 years sort of a number. We just saw that 3-year horizon. You actually tend to have a 7% possibility of losing money on the market. So running a core portfolio on a 3-year horizon is clearly a win-win sort of a situation for everybody. And again, liquidity will be still monthly. So what we have done out here, we have taken a portfolio universe and divided into 4 buckets, depending upon what parameters we have decided. The first bucket is our core portfolio, where we'll look forward to holding stocks from a 1 to 3 year horizon. These are like typically high growth, clean companies that we are looking to hold on for a longer horizon. Slightly lower on that parameter would come as my technical longs. There is a third bucket, the C bucket, which we typically put it as a review. We are not clear on that. And then there's a final bucket, which is the additional piece that we do, which are the stocks that we see as technical shorts. So it's not just the long sort of a part that we look at. We even look at the short piece as well. So that's how we have clearly divided the our universe into 4 buckets, and that's how it's been going to be operated. If you look at the difference between the two products, clear-cut differences. While the absolute return fund focuses on as the name says, absolute returns, we're looking at close to 12% sort of a number. The long short product will be benchmarked towards Nifty 200. So that's where it's benchmarked towards. Horizon for one product, while we're looking at a 12-month sort of a horizon, the other product will be looking at a 24 to 36 month sort of a time horizon. That's when we can generate the best of the returns. Range in the absolute return, it is slightly lower range. It's a low risk product, so it's minus 10 to 30%. But when you look at my long short product, I'm going to be aggressive there, minus 30 to 130%. Strategy, clearly differentiated strategy. The absolute return has two pieces to it: the market agnostic one and the market related strategies. The market agnostic one, creates an early cash flows which protects my returns, and that's how we benefit over there. And we have been able to generate non-negative returns for a pretty long period of time. While in the case of a long short fund, we'll be typically having market related strategies. So that's the core portfolio and the technical portfolio that we talked about. Risk, absolute return fund is a low risk, and on the long short we have slightly higher risk. Participation in terms of assets that we use, both the funds will be using equity and equity derivatives only. There will be no other asset classes that will be utilizing that. Coming to the returns of the first fund has been live from almost January 2021. These are the monthly returns over there. If you see, we have had only 4 months of negative returns, right? And out of that, also 2 were clearly because in one case, RBI had an early intermittent rate hike. And in the second case, the Adani-Hindenburg issue happened and volatility went for a toss. Markets went for a toss. So those were 2 scenarios when we lost some bit of money. But if you see, our average drawdown is around 20 basis points absolute. But on the higher side, we have been able to generate returns to close to 2%. So the whole well done because of the market agnostic strategies that we use, the harnessing of volatility that we discussed right now. On a longer stroll also, if you see, the returns have been decently well placed on a 2-year horizon, almost 9% sort of an IRR that we are looking at, and on 1-year horizon, it's almost 10.6% IRR that we have generated. So these are my pre-tax returns. So in terms of returns also, we are in line with most of the other asset classes over there. And finally, before we close down, we'll just like to share what has been our experience over last 3 years working on the long short piece. It's been a very interesting journey. It's been pretty challenging, but it's worth a discussion. So that's why we'd love to talk about it. So first thing that we both understood coming from long only funds is that the biggest problem is holding on to the positions. So there is a large inability towards holding on to the position. If you look at last 3 days, Nifty was 19,1700. Yesterday it was 19,500. Today back to 19,1700 and closing it again 100 points lower. So in that sort of a situation, there's so much of noise, there's so much of emotions running, it becomes difficult to hold on to the position. So for that, we have figured out a strategy which is called the CPT, the core, participating and technical, the one that we discussed in our long short fund. That's where we actually hedge ourselves well, and then we try to hold on to our positions for a longer haul. And that's what we typically tend to do. So that's the first piece. Second, returns cannot be linear. That's another piece that we'd like to share, that even in long short funds there are, or absolute return funds also, there are expectations of a linear sort of a return. It is difficult. So that's why we expect that on a 1-year horizon, we'll actually cover up for any gaps which have been created, but that's how the structure is. Short-term volatility bites. Now, this is a very difficult one. Any small event, any big event, the sort of volatility that we see, and typically we just discussed in a high inflationary environment, the impacts generally get magnified. So it's very difficult to manage that short-term volatility. So what we do is that we do position sizing very specifically, and we try to utilize our derivative piece within that. So that's additional piece that we should. And finally, shorts is very different. So shorts in equities is a very different animal. If you look at currently India structure, I think Abhishek also alluded to that. There is a full narrative which is around positivity, right? So everybody is talking about positivity. There is an SIP inflow of close to 15,000 crores. So always there is a value seeking proposition into some or the other stock. So the moves in stock tends to be very sharp. The third problem that we face is that generally stocks within sectors move together. So that also becomes slightly difficult. So we had our own challenges. I think we worked it to almost 1 year. Abhishek, probably, yeah, that was the time that we were. Yeah, and we sorted this out. And what we have figured out is stay with the week. So that's why in our second fund also, we have a separate basket for that, which is our tactical shorts. Again, we have rules to that. And that's how we have devised our strategy on the short side also. So stay with the week is what we say. And that's how we run that thing. So that's what we have been doing. That's us, our thoughts around returns, around volatility, around how risk management happens. I hope you found this interesting, and looking forward to your questions. Akshara, over to you.
Of course, it is. I must say it was a very structured webinar, because you started off with macros, then you spoke about volatility, and then about AF, and then about the products. I think you have covered a top-down approach now, actually. I must say that. And it was a very elaborate one. And the question, which was already before you could even start the webinar, we had one anonymous attorney putting a question. This question is very simple. Example, 𝐀𝐻𝐨𝐿 gold case in point. Lots of times we had a good idea, but to do deep drill sectoral and company specific research, it takes time. But stock usually jumps from 1 to 2x in a matter of 2 to 3 days. How do you structure a research process? And should you cover the breadth of the drill down on depth? Web holds 4 to 5 stock portfolio, which is extremely concentrated, whereas Dalio has less than 2%, in individual asset allocation. What do you think here? So it's very big question from an anonymous attendee.
As I understand, I'll just take that and then I'll up them. Yeah. So as I understand, he says, when you're drilling down the stock runs before that only, right? And that's why you have to do. We spent Aalap spent 17 years, I've spent 17 years. So we know the stocks. At some point of career, we would have seen at least Nifty 500, we would have covered at some point of time. We would have read annual reports and all. So what happens here is you have to have it in depth also and the vastness also. And that comes with experience, that comes with investing. And the best way to learn is when you buy a stock in your portfolio. That's where the real focus happens. And you got to keep reading annual reports. Even if the stock is not interesting, it's going to a bad times. We keep reading annual reports. We keep doing research on the stocks. We keep meeting the management. That's the only way you can be ready when the cycle turns. Because you can understand there are so many players who are covering so many stocks. And somebody would have an edge over you. The only way you can do that is whether if it's if a stock has gone up 1x, but the potential is of 5x, then you have to bite the bullet, understand the sector, and take that, trade or invest in that company. But that comes with experience. That comes with researching, across cycles. You can't today research about a stock and buy tomorrow. You got to be doing it, at least reading annual reports and, at least following that company for a while. Then only you can get that edge as the investors. As I understand, you want to put a big chunk of his money in that. That's where you get your multi-bagger first. Aalap, would you want to add something?
Yeah, I think totally agree with your piece. I think just like to add a couple of statements. So the first, we love this profession because it pays us for reading, right? So no other profession actually pays you for reading. So we read, and now actually things have gone online, so you can just listen to them and you get paid for it. So that's why we probably like this part of the business a lot. Secondly, I think exactly what Abhishek says is that you need to read, understand things more. And if you see a stock, initially taking that jump, you can take a breather, things settle down, because there is always an early euphoria into things, right? Then things settle down. So that's where we are talking about the whole sentimental part or the emotional part of the market, and then comes the more realistic part of the market. So yeah, take a step back, ease off. I think you'll get that opportunity. Market always gives that opportunity. So that's the second piece. I think one more piece probably that he was alluding as to having number of stocks in the portfolio, right? I think that's the second part of the question that he had. Yes. In terms of I think radio having more stocks and I think somebody having lesser stocks. Is that what was it, Akshara?
Yeah, so asset allocation is talking about.
It was asset allocation part of it.
Right. So that depends on the individual process. Everybody has their own thought processes around it, how they want to manage their exposures into number of stocks. So that is that will change from person to person. So as we even discussed about the multiple products that are available, so every product will have its own efficiencies and inefficiencies. So that brings how the number of stocks would be there. So that is how it gets structured. So
yeah, I think. Sorry, yeah, please.
Sorry, you were saying something.
No, when you said all of this, I had one more question in my mind, so I wanted to ask that. Sorry, please complete.
Please go ahead. Yeah, I'm done.
No, because these all things that you're going to say is because of the experience that you had in this industry. So both of you had over a decade of experience. And that's why, you know, we're going to say this. But these days, people are going for an AI kind of thing, AI board to help them with their investment. So the role of a fund manager is significantly, you know, it's going to reduce. And of course, in one of your slides, you said that AI is going to rule and will be one of the part of India's progression as well. So with that, so what is that you're going to see forward for this AI board investment happening? Either of you can answer again.
Yeah, I'll take it first. Abhishek, you can help me. We'll need help, right? We are supposed to fight AI, so the two of us have to get together. Okay, so if you look at investing as a process, right, there are three areas to it. You've got an art part of it, the science part of it, and craft part of it. So I'll start with the craft. Craft is actually doing what you know, right? So actual executions and actual algos and those things. That's been actually automated, and artificial intelligence, machine learning is already into it. And we are seeing that shift over there. Totally agree with that. The second part is science, which is rule-based, right? So there will be certain rules which you follow in terms of your investing, and you want that also to get automated because emotions shouldn't come over there. The first part over there is the art part. Now, the art part cannot be automated, right? You cannot have machine learning around that. You can have machines to supplement that. You can have somebody to help you understand things faster or make things for you quickly, and so that you can go through it. But the final art part, when you look at the promoter quality, when you look at the management quality, when you look at the business quality, business model, the numbers, and your hunch on it, basis whatever you've been doing for years now, right? Things are going around you in terms of environment. That is up to you. So that cannot be automated. But yes, there will be a point in time when there will be a lot of help which will come from there. So will AI take away fund manager's role? No. There will be two things which will happen. First, it will aid a fund manager's role. And second, it will create problems for the fund managers who don't understand AI. So I think that's what we look at it as.
So just let me add to Aalap, so COVID case, we are at COVID. The first time, US went till zero interest rates, 0.25, that's where they went. So there was no case study in history what happened during when the US has zero interest rates. Okay. And then the next year, you had in last, I think so, 5 decades or 6 decades, the highest interest rate hike cycle that has happened. Nobody knows. You can't have an AI telling you what's going to happen here. There are going to be cracks that are going to happen. And even today, despite you have the dot plots and all, so Larry Fink yesterday said, US, yields are going to cross 5%. Who can prepare you for that? That is where the art part comes in. That's where your experience, your judgment, and understanding of the industry. Even if you look at the Nasdaq rally that happened, a few months back, it was the AI stocks that were doing well, and they surprised the numbers for everybody. So this art part is going to be there. There are going to be cases of human service, which they're going to surprise you. So that you cannot take out of investing. AI, yes, data analysis, data analytics, and all that's going to be there. But so history doesn't repeat itself; it rhymes. So that's the classic case. How it's going to rhyme the next time, we don't know. So that's where our roles are still there.
Yeah, that's very true, sir. And one more thing is that these days, alternatives is no more a choice now. It has become a mainstream. So because from the tier 1 cities, I know the knowledge of alternatives and investments, these are getting spread through tier 2 and tier 3 cities now. So, and the knowledge has been increased, and Cat 3 AF has been more popular in India now. So how do you see that? Abhishek sir, to you.
Okay. Sure. So, when we started the derivatives, when I started my career, derivatives just started coming into India. And nobody was comfortable with doing derivatives. It was too risky. Even in management schools, when they used to explain, nobody used to understand in the class. Today, with the advent of, all the brokers, low-cost brokers, everybody, trading, IT professional trading options and futures. So then nobody believed you'll have ETF, the growth that ETF will see. That's coming. So now this is the time for alternates to come. I'll just take you an example. The leading hedge fund in Europe, Marshal. So when they started in 1999, their AUM was $100, $200 million. And they just started with seed money. Today they are at $62 billion. So, in India, we are 1 or 2, 1 decade behind what global is happening because the way our GDP is. But this is the time for alternates, because that's where, the new products, the new risk profiles that are going to be, catered to for the family offices. Look at the family office boom that is happening in the country. So even 10 years back, they were not that much, or even 5 years back, but everybody is now trying to set up. So this is the wealth of opportunities that's going to be there for alternates. Aalap, anything?
Yeah, I think 100% agree. I think 2 decades back, it was derivatives, which was disbelief. A decade back, it was ETFs, which was disbelief. And now come up with alternates. 100%, yeah.
To Aalap, sir, I have just this one question. Market is all-time high. Of course, Nifty is at the end of its team now. With that, from an investor perspective, they might say we could go for a passive investing kind of thing.
Yeah.
So why do you say that active investment is much in need now?
Okay. So at this point in time, at close to 20,000, there'll be 2 scenarios, right? You are either fearful, or you are looking forward to more, probably, hopefully not missed mess. That's the thing. So in that case, active management would help, because there are a lot of new themes which are coming up, right? There are a lot of new ideas which are coming up. So stock selection as a process would become more difficult, right? It would become more interesting. So that's where a whole new opportunity towards active investing will come up. Where does long short fall in this whole category? Okay, there are two things. First, if you're looking at a situation where you want to hedge yourself, it's only through long shots that you have a capability to hedge yourself. So that's where it comes handy. So you can manage your exposure in that sense. The second side, you want to go slightly more aggressive on the market. Again, that's where long shot can chip in, and you can be better placed over there. So typically, historically, how it was placed, right? In such situations, people used to tend towards more balanced fund sort of a situation, right? So you've got exposure to some bit of debt and then some bit of equity. Now that has changed through alternatives, where you've got a Cat 2 sort of a thing which can provide you credit funds, and Cat 3 sort of a thing which can provide you a long short fund. So I think because the multitude products are available, along with ETF as a exposure, everybody would have some bit of exposure going into a long only structure also. And thirdly, I think from a people perspective, there are a lot of boutique opportunities which are opening up, the boutique fund management outfits which are opening up. So that also gives an opportunity for people to benefit from the experience of multiple fund managers. So I think the whole structure is going through a revolution, in my words, right now.
Yeah, thank you, Suzanne. I'll take a question from the audience, from Adarsh. He had a question. Won't a downturn in US economy bring a slowdown in the Indian IT sector? If not, when can we see a clear growth in trajectory of IT sector? Let me just tweet it a bit. Not only IT sector, I just want to know any other sectors if you guys are bullish about in the strategy. Either one of you can answer this.
So IT sector, there are still innovations happening there. So if you look at the AI boom that is going to come there, that is a huge thing that's going to be there. The cloud, that is what we are into, the Zoom. So that trend is going to be there. So yes, economic slowdown, yes, the budgets will start coming down, but there are still opportunities, pocket of opportunities, which the company is catering to what. So you have to be a very good stock picker in that sense. What company is doing that? In terms of other sectors which are very exciting, I talked about defense, then the manufacturing space, the green transition that is happening. So when you're talking about EVs, the EV infrastructure, the drones, these are going to be the new sectors which are going to give you growth. And where growth is, the market, the valuations are going to balloon up to some extent. So that's where you got to find your opportunities here. I mean, just to tell you who envisaged that defense is going to be such a big thing in India in terms of exports. And with the geopolitical risk about it, you've got the tailwinds in the sector. So there are pockets of opportunities that are there, but the investor has to find out that. Aalap, anything?
Yeah, I think agree. IT becomes a broadly defined one. So every company becomes like an IT company, right? So there are multiple subsegments within that as well. So you need to look at the correct subsegment which would do well, where growth is there, where margins are still open, and we've seen decent returns numbers as well. So that is the area which is there. On the broader IT sector, when will it start recovering? I think it's obviously going to be linked more around the US piece. But if you want to be stock specific, yes, there are smaller pieces of opportunity out there which are available.
So with that, I have one question to Mr. Aalap, sir. Thing is that when you showed your last performance strategy, Of course, India has faced a Russia-Ukraine war. We had faced COVID, and we are now with a bit of recessionary fears here and there exists. And what is that strategy? How do you cover your strategy from these unpredictable downturns that we have?
Okay. So 3-4 different pieces that we have within our strategy which helps us do that. So first would be the market agnostic piece that we run. Market agnostic piece is typically where we close down the direction and we have a view on the volatility. That's where our initial P&L comes by, or initial cash flow comes by. That gives us a clarity of idea as to how our fund performance is going to be for the forthcoming time. That becomes our worst case, and basis that we are able to generate our return. So first piece is that which creates good base for us. Secondly, the downturns always bring about certain opportunities in terms of sectoral allocation. So I think Abhishek has been alluded about the defense piece and a couple of other consumption ideas that we have been looking at. So with that, our stock picking has helped us on that side. Third, we are long short guys. So we had opportunities to short and we had opportunities to go net short on the market as well, right? So there have been instances when we were net short on the market as well. There have been instances where we were short on stocks for months together. Certain stocks where we were short on them for months together. So those 3-4 pieces that has been helping us. So a situation where we have flexibility. We have been having so much of flexibility running a Cat 3 product that has helped us generate the sort of alpha that we have generated during the difficult times. So if the macro is difficult, the micro is difficult, and your product is also very restrictive, then returns become very difficult. But if even one thing comes into your favor, I think you make a bit.
I think that was a very true answer. You never added any quote of sugar, but it is a very true answer that you gave. And I had this question. For one fund, there are 2 fund managers. So how do you split between you? And what are decisions like each one take in terms of calls, like aggressive calls or like, calls which are moderate or something like that? Is there any difference between that? Anyone can answer this question again.
Even our boss asks this.
The audience will also have that.
Whose idea was this? Ye kiska idea tha? So then we look at each other just the way we are looking right now. Okay, so let's understand this. So we have formalized the whole process, right? So between the 2 of us, we are very clear which areas we would be looking at, where whose strength comes from. And what we have done is we have created our universe of stocks. Within that, there are certain parameters which are looked by Abhishek. Secondary would be me. There are certain parameters which are looked by me. Secondary is Abhishek. So we talk and discuss a lot, right? So because interaction is finally the whole piece out here. So we interact a lot on those sides, and we have formalized a whole structure in which we classify the stocks. So once that stock gets classified into a particular bucket of A, B, C, or D, so whether it's a core portfolio stock, a tactical long, or a tactical short, then from there picking it up becomes very simple. So our selection process gets done over there. It is only the allocation piece that we have to otherwise discuss on a daily basis. But from a quarterly or a 1 full year sort of a horizon, our buckets are clearly defined, right? So that's where we have our pieces done. Our portfolio review process is almost a monthly sort of a thing where we dedicatedly apportion time, or at times more than once in a month also, where we have seen requirement for that. But that's where we divide our responsibilities. So divided the responsibilities, created a centralized pool for it, and based on that, we have created buckets wherein the whole division of stocks or our universe stocks happened. Once that is divided, it's all an allocation process.
Everything is dual check now.
Oh yeah.
And what's happened is the product defines that. So what kind of product style you are running, and that helps you with that. We have clear-cut, defined rules for hedging. That helps us to control our, euphoria in place, because that's where the whole system and the processes come down. And since we sat down and did it together, so that's where we clearly understand and we know the biases of each other. What his bias is, what my bias is.
So just one last piece to add. Sorry, Abhishek. We come from different backgrounds. Abhishek had been from a long short guy to a mutual fund industry. I came from sell side to insurance, right? And then we met up over here. So the whole structure has been covered between the 2 of us. So all those experiences that we have been getting over these years, we have been trying to punch into this fund management process.
Yeah, because the finance industry, that ball now. And so last but one question that I have is that like you'll have some good insight because you have 2 decades of experience. So if you want to share one call or the recent call that you've taken in a strategy, recent any changes that you've made in your strategy, because anything that you could share you want to share with us, with the investors, either of you again.
Okay, so we have fine-tuned our strategy. If you look at, so the broader piece is in place. So that's almost a year back. If you look at, the broader structure is in place. Now what we have got to do is the fine-tune our strategy. So that's where the fine-tuning comes in, with the understanding of the macros, the way the funds behave, the stocks behave, and that comes from our experience and the processes that we have laid, the segregation of stocks that we do. So that's it. So we are continuously fine-tuning because every day we learn something new, a new strategy, a new way of handling risk, and that's where so broadly we are just improving our style, and that's where you can see in our returns also. It's becoming more consistent in that sense. So I would not say we have put the structure in place. We are fine-tuning what we do. So every day that's a new thing. So every day, what do you say in cricket? Match practice improves your game. So that's all. Nets mein kitna bhi batting kar lo, but once you're in the game, in the match practice, that's where we learn a lot. Aalap, anything?
Yeah, I think a few things which came handy, like in July, if I remember correctly, July, we was more long towards indices, and on the stock side, we were slightly less aggressive. Come August, I think we realized that we have hit all-time high. And probably there will be some bit of consolidation from there. So we reduced our indices, the strategies around indices, and we moved more towards stocks. We started focusing more towards mid-cap. So clearly, as you refine your process, as Abhishek says, such sort of ideas keep coming in. So over last 2-3 months, those sort of ideas have come in extremely handy to us. And that's what has helped us through.
Yeah, because I want to add one more question. There are a lot of questions falling on the podium, and to commonize all those, you have MRAs and MAs, which is market agnostic and market related strategies. So it's like you cannot be biased on either of it. So how do you manage both? Because both are too different.
Right.
So how do you manage both in one single strategy?
Okay. So the broader allocation between market agnostic and market related strategies is hard-coded stocks. Right? So that's defined, right? So how much allocation would go into a market agnostic one is clear. How much would go into a market related one is clear. But within that, we have got multiple strategies. So exactly that's the reason why we say that we are a multi-strategy fund, because there are two, bigger buckets of strategy, and within that, we have got smaller pieces of strategies that we run. So within that allocations, I can keep shifting things, right? So for instance, on the market related strategies, I may not run any index related strategies. I may have a total long short portfolio, or even a broadly slight bit of a short portfolio also. That freedom is there within the market agnostic and market related one. But within the two pieces, it's going to be more so 50-50 sort of allocation between the two. That's where we have hard-coded that, right? So in terms of our first return profile, I'll say how it works, and then risk profile, I'll come to that. So in terms of return profile, we are clear that first, non-negativity. So we try to generate positive returns. So that's my market agnostic one piece. Then my market related strategies, that gives me the initial uptake. And still, if we see opportunities available, then we try to take the next leap. So if you see our returns, it would be either 0, close to 1%, or it will go to 2%. And exactly that's how we trajectorize our exposure in the market, right? So market would be like positive returns, flat returns, or negative returns. We try to make it as negative returns, good returns, or very good, decent returns and good returns. Let me be this thing. So that's our returns piece. On a volatility piece, again, that's how we work out. Because we have market agnostic one, my 50% of the portfolio, I have managed my volatility piece. So it's the remaining 50% which I have to focus on, right? So my market agnostic is you cover the directional piece and you focus on volatility. On the market related strategies, I am playing on I'm taking the direction into account, but I am covering my volatility piece. So that's the only piece where I have to take care of the volatility part, right? So I'm as such reducing my volatility risk by 50% by running that market agnostic. So that's broadly how we define our strategy.
Yeah. So Abhishek, so you want to add something?
No, I guess you covered most of it.
Yeah. So with that, we have come to the end of the session. The sessions will ideally get over by 5:30. We've already extended by 10 minutes. So thank you for that, and thank you and for giving us such an elaborate session on markets and about the portfolio and about the products. And of course, with this, of course, the participants would have got enlightened. Thank you all for that, sir.
Thank you, Akshara and the PMS Bazaar team.
Yeah.
Thank you, everybody. Thank you for your time.